Hi, and welcome to another session of Venture and Capital Interviews. Today, I have the head of the currency strategist from Western Union, Mr. Stephen Dooley. Welcome, Stephen.
Thanks, Steve. Thanks for having me on today.
Mate, what a brilliant time to be hosting a session like this where we can talk about all the things that are happening in the world, the crazy things that are taking place, but most importantly, how it impacts currency. And, obviously we work with a lot of companies that, do a lot of business overseas. And likewise, we've got investors that are also sort of dealing with international business dealing. So really looking forward to sort of, understanding what your perspective is for, the outlook for sort of, at least the first half of 2021 and then potentially the second half as well.
Absolutely. I mean, Steve, the Australian dollar is one of the most volatile currencies in the FX space. On average, it moves 19% per year. And that's just the average. So it disguises the fact that it moved 50% in a year back during the GFC. And sometimes, like the early 90s, it moved about 10% per year. Moved 35% range last year. So we certainly are in a moment where the Australian dollar, particularly if you have exposure to it in your business, can create some real headaches if it moves unexpectedly.
Well, from my perspective, it actually moved in the right direction, given we have, payments to make in the UK and also in the US. But just for you, how do you, when you're sort of going into 2021, you're kicking off the year, we're obviously now in sort of early February. What are you looking at as far as for indicators for what's going to be happening on sort of pricing and, what sort of currency pairs are you looking at the most?
Well, the majority of our clients and the majority of business in general use the US dollar as their currency to make payments or receive payments in. So that continues to be the most important currency. And so the Aussie US remains the most important currency pair that's out there. So that really does tend to drive a lot of what we're forecasting. So initially, start off with some of the basics. The different interest rates in the two countries tends to be the number one driver of what will impact on the currency. So, for example, at the moment, we've got interest rates very low at the moment at 0.1% at an all-time low. But the incredible amount of money printing coming from the US overwhelms everything. So we're in a phase at the moment where the US dollar's in a very major declining phase. It has been for the last 12 months. That's what's caused the Aussie dollar to jump from 55 cents to above 75 cents where we are now. And so a major part of the game is going to be focused on the US dollar, focused on what the Federal Reserve might do, and continuing to try and get an understanding about when they might start winding back that money printing program. But for now, using the old economist cop-out, all things being even, the expectation is that for now, the US is going to keep printing money, and that should mean that asset prices around the world push higher, and the Aussie dollar is more likely to push higher as well.
Okay, I will drill down on questions in that area in a second, but just from a global economic outlook, what are you seeing?
Well, the economic cycle, and I'm sure everyone on this call or watching this recording will know that the economic cycle tends to move in a fairly predictable way. What we tend to see is a period of major contraction, some kind of economic crash, and that's followed by an eventual recovery. So you don't need a degree in economics to know the last 12 months, 2020 has been a horrific year for the global economy. It was the biggest contraction in economic growth, the quickest contraction in economic growth that we've ever seen. So we know that we started 2020 or went through 2020 in that period of contraction. Now the real focus is on when we might start to emerge out of this slowdown. And it seems like we're already quite substantially out of that slowdown. If you look at some of the most up-to-date readings of the global economy, the JP Morgan Global Manufacturing Activity Index is one of my favorite guides to look at. And that's absolutely had a huge rebound over the last 6 months. It's now in a period at a reading that signals very strong growth, the strongest growth in over 4 years. So it appears that we're in a phase now where we are in a more positive period for economic growth. If you look at copper, for example, that's at 6-year highs. That's a very key indicator of global growth expectations. They say it's the only metal with a PhD in economics because it's such a good reading for what might happen out of the global economic picture. So that's a strong sign. Locally out of Australia, iron ore's at a 9-year high because of the global demand for that. So all the kind of key measures of global activity show that after the biggest contraction we've seen in our lifetimes, the global economy is set for a very significant recovery in 2021. So from that perspective, that's a real positive note to start the new year on.
Well, you mentioned two important things, right? Obviously, you mentioned about the most significant contraction that we've seen, in a long period. And then the second part you mentioned about the massive amount of stimulus that's actually going into the economy. And you're seeing that sort of play out through the financial markets. So the hard part for me as sitting on the investor side, you can see that, we've got record amounts of IPOs on the ASX. Obviously, it's still a very low interest rate environment, but also at the same time, it's a hard thing when you've got the markets that are doing so well and also, record unemployment in many, many regions around the world. So what do you, how does this play out on the financial markets from your perspective?
Well, Steve, I think this is going to be the most interesting story that we have in 2021 because we talk about that amazing contraction we had in growth and that strong recovery. The most interesting factor is that because it happened so quickly, financial markets didn't really seem to get the time to readjust. They didn't have that crash and that slow rebuild that we normally see. Think about the GFC. We had 2 years of pain before we recovered. Think about after the technology bubble in 2000 to 2003. It took 3 years to work out the excesses out of markets. This time around, markets didn't blink. They fell sharply through February and March, and then they just continued straight up. Now, interest rates have been near zero for record time for the last 10 years. So the financial market story, for a very rare occurrence, seems to be out of sync with the global economic cycle. So the global economy has had its crash and it's recovered. Share markets fell, but not by any significant extent. And they, certainly up 20, 30% from their highs where they were back in February last year. So financial markets seem to have just continued to get more and more buoyant. And it doesn't matter where you look, if it's the cryptocurrencies, if it's the incredible moves we've seen in US technology stocks, Australian property, of course, we've seen a huge rise in that, even during a economic recession. And then, of course, what we saw in the first part of the new year, crazy speculative activity in heavily shorted stocks in the US, your GameStops, your AMC Entertainment. So all the kind of real frothy activity that you see in financial markets has continued unabated. So I think as we go into 2021, the $1 million question is, which one of these cycles is going to win out? Is it the global economic cycle that's recovering strongly and painting a very positive picture? Or is it this super frothy 10-year bull market that's all of a sudden looking like it's carrying more and more risk? So again, while the economic forecasts look more positive, there still remains risks. And those risks in particular, I think, are markets, asset prices, and interest rates, which, as you say, are at extremely low levels. And it's funny, it doesn't take long for very low interest rates to create a real sense of risk-taking right throughout markets. And as I said, whether it's cryptos, speculative, Australian property.
All the fun stuff.
It's all firing on all cylinders at the moment, Steve.
And I suppose the other part is if this is just you sort of, if you're looking into your crystal ball, because for me, I know that I've said to our team that, and I've talked when I talk about, because obviously we look at it from a capital raising perspective, right? And we can see how much cash is in the ecosystem at the moment. And we can see that there's strong investor appetite. But we also realistic, and we know that this environment doesn't last forever. So if there was to be some sort of trigger that sort of stops that bull run and does impact the financial markets, what would we be looking at for as some of the triggers to be looking out for?
Well, I think it seems like the global economy is recovering fairly well. So historically, it's been once the Federal Reserve takes the punch bowl away and starts to spoil the party. So you look back in the last big rally that we had, post 2010, 2011, we saw gold go up to $1,900 an ounce. We saw the Australian dollar go up to $1.10 versus the US dollar. So again, that real speculative fever. And then it was when the Federal Reserve started to say that we're going to slowly taper away, we're going to reduce some of the money printing programs, and markets threw an absolute fit because that time of extremely low interest rates, suddenly they were looking forward and thinking, well, what's the new environment going to be like? So I think that's going to be the real pressure point for financial markets when we start hearing central banks are thinking of removing some of that stimulus. But both the Federal Reserve and the Reserve Bank of Australia have told us that we've got at least, 2.5 years now. They said last year that they're both going to keep rates at current settings for 3 years. So, when does the rubber hit the road? When Australian property prices go up another 20 or 30% a year, when US share markets are up another 30%, when inflation kicks back, are they going to be able to maintain that view of keeping interest rates for another 2.5 years? If suddenly they start to see the risks coming from other parts of the economy, that's, I think, where we're really going to start to feel a bit of pressure in financial markets. But for now, it seems we're in a very positive phase. You talk about fundraising, you look at the United States where those special purpose vehicles, the SPACs or the so-called blank check companies are raising a tremendous amount of money. When you can go to the market with no purpose and no strategy and just say, give me money, and the market gives you money, then you're in a fairly optimistic period of financial markets.
Now, obviously, at the end of last month, we had the inauguration of Joe Biden. So I think the simple question is he going to be the one that sort of instigates the taking away of the punch bowl, or is he bringing a second bowl to the party?
Well, I guess it depends on which party you're at, really, Steve, because he's certainly focused at the moment on providing plenty of support for the, for the American working class. So the stimulus checks, the focus on family tax benefits. So they are very focused on providing that stimulus to the hardest hit by COVID-19, and of course, so they should. The question is how much appetite they have to push through some of the shifts in policy for some of the higher income bracket. And they've said that some of Donald Trump's tax cuts for the highly paid, they want to wind those back. Some of the impact on capital gains, they're focused on that. They've said they wanted to introduce measures to try and get more tax back from that space. But the question is whether they really want to now. With the US economy in a more precarious position, there's probably going to be, that's an opportunity for another day at the focus. At the moment, let's try and focus on providing as much support as we can to the US economy. So you might remember that before the election, if Donald Trump lost, that was going to be seen as a negative for share market because Joe Biden was going to raise taxes. And then when it was a split Congress, the concern was, as long as Joe Biden doesn't win Georgia and take control of the Senate, they'll block some of the worst parts of his policy. Of course, he won Georgia, won the Senate, and equity markets kept going up regardless. So it seems like that markets, as we mentioned, just want to keep going up. But for the moment, they think that we're probably a way away from some of those more market negative policies that Joe Biden has said that he wants to introduce, but might not have the appetite to do it right now.
And I'll also note that some of the states now that were previously on lockdown, even though they've got incredibly high cases, they're now sort of ending that sort of lockdown and allowing people to start getting out and moving again, which I imagine helps in different areas. Now, the other thing I thought was really interesting is you look at some of the European economies, and I'm sure this is obviously represents global, but COVID's obviously impacted a lot of global trade, right? As far as whether it be restrictions on logistics or, the international freight or whatever. What do you like? What is the outlook and what's the forecast for you for global trade? Like, what are you seeing?
Well, it's a very complicated story, so I'll try to keep it brief. But initially, global trade was on a bit of a weaker footing back in 2018 and 2019. Whether it be the slowing economy, and the economy was slowing into that period, whether it be that US-China trade wars, what we'd seen previously. And then initially, of course, that impact of COVID-19 had seen trade on a very backward footing in 2018-19, compared to at least to what we saw during the last economic crisis. In the last economic crisis in 2008 and 2009, global trade was absolutely pumping going into that. So that provided a bit of a cushion. So this time around, global trade was already on a bit of a back foot. But that said, COVID-19 didn't have the kind of negative impact that we might have thought. And initially, you look at some of the initial forecasts for how things might play out. And this has been really true of most parts of the global economy, but it didn't turn out as bad as most economists originally thought. So
trillions of stimulus helped with that.
Absolutely. I mean, the levels of stimulus have been absolutely incredible. And, you look at retail sales, they've just been globally just absolutely beating expectations right throughout the global economy. So global trade did hold up a lot better than expected. And then the third part of the equation, so weaker going into it, better than we thought during it, but afterwards, like you say, people can't travel overseas. So if you're sort of a higher end retail operator, if you're putting in spas, you're putting in pools, if you're doing extensions, if you're selling jet skis, if you're selling caravans, you can't get the stuff out of China quick enough anymore. So that's the other part. There's big bottlenecks because, of course, there's a lot of restrictions on working as well. But it seems like only about a third of exports from China are now delayed, so missing their target export date. So that's the final part of the puzzle, is that global trade isn't able to keep up with demand at the moment as well. So it is a complicated story out there at the moment, and it does have its problems to deal with going into 2021. So it's certainly, from one perspective, it's done better than we thought it might do, but it still has problems, particularly in trying to get things out and get things moved around the globe in restricted operations for working. And think about trying to get into the US at the moment. It's hard to get out of China, out of the US. I tried to buy my wife a bottle of Chanel No. 5 last week for her birthday, and the warehouses in France are locked down. So that was my excuse in any case. So, but it's just right throughout the global trade supply chain, we're seeing more and more that it's hard to get product to market. And that's a problem globally, and it's a problem for our clients as well, because a lot of them are focused on that retail, getting product out of China.
You mentioned at the start that the biggest pair, I suppose, that you sort of trade in is the Australian dollar to US dollar. So, and obviously we've seen a massive change in that in the last 12 months. What's your forecast for the next 12 months?
So we're optimistic on the Aussie US. We have a 12-month target of 82 cents. So we think it's going to continue to drive back higher. If you look at the Australian dollar during periods of economic growth, it's actually a pretty clear historical move that you tend to see the Aussie rally very significantly of times of global economic outperformance. And as we sort of said at the start, after that big contraction in 2020, the expectations is for global growth to improve. And we mentioned copper at 6-year highs, iron ore at 9-year highs, the kind of condition that tends to drive the Aussie dollar higher. back in 2003, as we emerged post the tech wreck, the Aussie jumped from 60 cents to 78 cents in 9 months. And in 2009, of course, we jumped from 64 cents to 92 cents in just 9 months. So once it gets a head of steam on it, the Aussie dollar can really rally significantly. I mean, the last 2 months of 2020, we jumped from 70 cents to 78 cents. So an improving global economy really does tend to cause the Aussie dollar to outperform. So our target's 82, but we think it can go a lot higher over the course of the year as well. I mentioned it moves on average 19% per year. So we started the year around 75 cents. So a year where we go up to 85 cents and down to 70 cents would actually be a pretty average year for the Aussie dollar. And if you're an importer, that can make a huge difference between buying your products at 85 cents compared to buying your products at 70 cents. It's a 20% difference in the cost. So that's really what we're trying to do, make sure they don't get a 20% hit and hopefully are able to take advantage of a 20% gain.
Well, I definitely won't be disappointed to see that play out like that. And just a quick question on the pound. Curious as to your forecast with the pound as well.
So again, the Aussie dollar tends to outperform the British pound during periods of economic growth. So that's a more positive. But there's a bit of a caveat this year because, of course, the pound have been absolutely smashed for most of 2020 because of concerns about those Brexit negotiations. They were absolutely tortured throughout the course of the end of 2020 in particular. So that allowed the Aussie pound to push well above that 55 cent or 55 pence level, I should say. But since January, the pound's been having a pretty good run. So for now, I think the next couple of months, we might continue to see the pound benefit from some of that more positive view. And also the pound tends to react quite a lot to what's going on in the US dollar as well. British pound, US dollar has historically always been a heavily traded currency. So there's a bit of an advantage in that one. The pound might be a bit stronger over the next couple of months, but over the course of this year, historically, the Aussie pound tends to outperform during periods of economic growth. So we're certainly looking for a move, maybe up to around that sort of 58, maybe even 60 pence level towards the end of this year.
Interesting. Now,
that's good news for you.
Yeah, it is actually. Those two are both good news for me. Now, you obviously work with a lot of companies. You assist them in moving money into all sorts of places around them. Just want to get some perspective on how you actually help companies with their currency risks, with just all the things, because obviously it's very, how can I say it? When you're dealing with international, there's obviously a risk there. Right. And especially if you're moving large amounts of money. So how do you work with corporates and how do you work with investors to protect themselves and to sort of hedge against those risks?
Yes, I guess there's probably three parts to what we try and do for our clients. And first of all, we're a payments company. That's the most important part of what we do. We've been around since 1851. We're a Fortune 500 company. We're one of the most established FX counterparties in the world. So, we've got the global reach. We've got 29 offices around the world. We've got 500,000 agent locations, and we've got 71 countries in our clearing network. So we've got that local knowledge, that global reach to be able to make payments effectively and quickly for you. So let's make no bones about it. The most important part of what we do for our clients is getting their payments quickly. Make a payment to a supplier, you want it to get there quickly, and you don't want to be arguing with the supplier about whether the money's arrived or not. So that's the core part of what we do. But we also do payments for more broader businesses. Our bulk payments team work for education. We do a lot of the universities in Australia. We do financial institutions, we do legal and payroll. So we do bulk payments as well. So really it's about that technology and that local knowledge and the network to be able to make payments quickly and effectively. We're also, like I mentioned, very focused on technology. So we try to make sure our clients have a really good understanding of their current position, their risk and their payment history as well. So we use the Edge platform to help our businesses, our clients, really have a clear understanding of the certainty over their payments. And then finally, the risk management side of the equation, which is what I really specialize in, which is helping our clients understand those big risks in financial markets and putting programs in place to make sure that, as I mentioned, they're protected from a move against them, but still have the ability to take advantage if the market moves in their favour. Can have a huge impact on their business by having the right strategy in place. And when we say the right strategy, we don't mean predict the future, listen to me, and my forecast is for 82, so we predict everything around that expectation. It's about understanding the risk and the opportunity in markets. And I mentioned the Aussie moves 19% per year. Put a program in place that no matter what happens, you're protected. No matter what happens, you can take advantage of the move in your favour. So it's really about understanding the potential outcomes in financial markets and making sure that you've got the right kind of strategy in place that helps regardless of what happens.
And Stephen, I suppose the final question for me is, how can people contact Western Union or especially the business solutions team? And then the last part that I would have is that, for you, you're just mentioning about businesses, if they do have FX exposure and stuff like that, do you have a specific direction you can point them as far as how that you guys can assist?
Yeah, absolutely. I mean, they can certainly go to our website, business.westernunion.com, and they'll be directed to one of our local agents that are able to help you, our risk management experts or transaction experts. So that's certainly probably the easiest way to get in contact with them. And that website also has a whole lot of detail about the way foreign exchange markets move, what we try to do to help businesses and different strategies to help different kinds of businesses, whether you're an importer or an exporter, whether you're an importer with a very smaller margin that might not be able to take on any kind of FX risk, or a business with a broader margin that wants to try and take advantage of some of the markets that some of the moves that could potentially benefit their business. So a lot of what we do doesn't come down to what we think is going to happen in the market. It comes down to understanding what the business is, what the risk appetite of the business is, and going from there. So for most of our clients, they'll meet with a transaction expert and a risk management expert. We'll try to put together a strategy for them to help them really make payments effectively and quickly, and to be able to have a really effective risk mitigation program in place as well. So absolutely, I think the website will be the best place for anyone to start.
Brilliant. Well, Stephen, thoroughly enjoyed this chat. Really enjoyed obviously getting your insights into what your expectations are over the next 12 months. Good news for our company as far as who we deal with. Thank you so much for your time.
Thanks a lot, Steve. It was great talking to you, and I really appreciate your time as well. Thank you.